January 30th, 2026. 6 hours. That's all it took to erase $10 trillion from existence. The screens told you it was a market correction. They said investors got spooked. They called it healthy volatility in an overheated sector. But let me tell you what really happened that Friday morning. This wasn't a crash. This was a foreclosure. A liquidation event so precise, so surgical, so perfectly choreographed that when you see the full ledger, you'll realize you weren't watching markets. You were watching a script execute in real time. Gold fell 15%. Silver dropped 40% in 6 trading hours. Not 6 days, not 6 weeks, 6 hours. And here's what should terrify you. No war started that morning. No bank collapsed. No emergency broadcast interrupted your breakfast. Complete silence from every major news outlet, while $10 trillion bled out of the global financial system. The kind of silence that only happens when everyone in the room already knows what's coming. But this story doesn't start on Friday. It starts 72 hours earlier with a single sentence from the President of the United States. A sentence most of America completely missed. Tuesday, January 27th. President Trump steps to the microphone and says, "America needs a weaker dollar." He says we should follow China's playbook, devalue the currency, boost exports, make American goods cheaper for the world. To ordinary people watching at home, this sounds like policy, boring economics, background noise. But in every trading room from New York to Singapore, phones started ringing, because traders understood exactly what Trump just announced. He wants a weak dollar. And when the dollar weakens, gold rises, silver rises. Precious metals explode because they're priced in dollars globally. Within hours, the trade was on. Hedge funds started shorting the dollar. Asset managers loaded up on gold futures. Retail traders piled into silver with every spare dollar they had. Billions moving in one direction. Everyone betting on the same outcome. Weak dollar means strong metals. It was the most crowded trade in modern financial history, and that's exactly when the trap was set. Think about the scale of what happened next. By Thursday, January 29th, gold hit $5,600 per ounce, the highest price in human civilization. Silver broke $121. The gains were biblical. Silver had rallied 68% in January alone. That's the strongest monthly gain since December 1979, almost 50 years ago. Social media exploded. Every financial influencer was bullish. Analysts called for $200 silver. Some said $500 was inevitable. On Monday of that week, the iShares Silver Trust saw $171 million flow in from retail investors. $171 million in a single day. The largest single-day inflow in the history of that fund. Double the previous record set during the silver squeeze of 2021. The total silver market had grown to $6 trillion. Larger than Nvidia, larger than Apple, larger than Alphabet. One analyst called silver the meme commodity of 2026. Everyone was euphoric, everyone was winning. Portfolios up 50%, 100%, 200%. Thursday night, people went to sleep dreaming of early retirement, and none of them knew that while they slept, the execution order had already been signed. Friday morning, 6 a.m. Eastern Time. Most of America still in bed. Markets haven't opened yet. Coffee brewing. Alarms going off. And then the headline drops. President Trump announces his pick for the next Federal Reserve Chairman, Kevin Warsh. If you're a normal person, that name means nothing. Just another suit, another bureaucrat, another face in Washington. But if you're a trader, if you understand how the Federal Reserve controls the entire monetary system, that name just sent ice through your veins. Because Kevin Warsh isn't just any economist. Kevin Warsh is what they call a hard money hawk. A man who spent his entire career fighting against easy money, against low interest rates, against a weak dollar. The exact opposite of what Trump signaled on Tuesday. Do you see the contradiction? Tuesday, Trump signals weak dollar. Traders short the dollar and buy metals. Friday, Trump appoints a Fed chairman who believes in strong dollar policy. The same traders who shorted the dollar on Tuesday were now forced to buy it back on Friday, The same traders who bought metals on Tuesday were now forced to sell on Friday. Forced reversal, forced selling, forced liquidation. Tuesday and Friday, same president, opposite signals, 72 hours apart. That's not confusion. That's not a policy mistake. That's a bear trap that closed in 3 days. But here's what makes this truly diabolical. Even with the wash announcement, silver should have fallen maybe 15%, 20% at worst. A painful correction, but survivable. What actually happened was 40% destruction in a single session. How? Because there was a third player in this game, a player nobody saw coming. China. Let me explain how precious metals markets actually work. When prices fall, there's usually a buyer waiting. Someone who sees value. Someone who steps in and says, at this price, I'm buying. For precious metals, that buyer has always been China. They're the largest consumer of silver in the world. They use it for solar panels, electronics, electric vehicles. They have an insatiable appetite for the metal. Usually when silver crashes, China steps in. They buy the dip. They provide liquidity. They put a floor under the price. But Friday was different. At the exact moment when the market needed a buyer. At the exact moment when sellers were overwhelming the system. At the exact moment when liquidity was disappearing, China made a decision. They stopped buying. The Shanghai exchange suddenly raised margin requirements. They stepped back and let the carnage unfold. Think about this situation. American traders want to sell their gold and silver because Kevin Warsh signals strong dollar ahead. But the buyer who always catches falling metals just walked away. Sellers everywhere, buyers nowhere. What happens in a market where everyone wants to sell and no one wants to buy? The price doesn't fall. The price collapses. And that's exactly what happened. The algorithms smelled blood. Stop losses started triggering across every exchange. Margin calls went out across every brokerage in America. Traders who were up 100% last week suddenly got liquidation notices. And once the cascade started, nothing could stop it. Silver went from 121 to 115, then 110. Then it broke below 100 for the first time in weeks. The psychological level everyone said would hold forever. Gone in minutes. 95, 90, 85, 80, 75, $46 erased in 6 hours. The ProShares Ultra Silver ETF crashed 60%. If you had $10,000 in that fund Thursday night, you woke up with $4,000 Friday afternoon. Gold fell from $5,600 to $4,700. $900 vanished per ounce. 3.4 trillion of gold value wiped out in a single session. One trading desk called it a capitulation event. Another called it the largest single-day wealth destruction in precious metals history. $10 trillion. One session. Gone. But here's where the story gets truly interesting. After the crash, I went through the actual trading data, not the headlines, not the analysis, the raw numbers from the exchanges. And what I found changes everything. On Friday, 531 tons of silver contracts were traded in Shanghai. 531 tons. That sounds massive. That sounds like real selling. That sounds like people dumping their silver in panic. But here's what the data actually shows. Physical silver withdrawn from Shanghai vaults on Friday? 0. Let me say that again. 531 tons of silver contracts traded. 0 tons of physical silver moved. Not a single gram of real silver left the vaults. So what actually happened? Paper. Pure paper trading. Shorts needed an exit. They got one. They pressured the price down with empty paper contracts. They closed their positions at lower prices. And buyers absorbed everything at the bottom. This wasn't a crash. This was a position transfer. Shorts exiting. Longs entering. Paper changing hands while physical silver sat completely untouched in vaults. The screens showed chaos. The vaults showed nothing. Now let me show you a number that will make your head spin. On Friday, when COMEX closed, the paper price of silver was $84. On the same Friday when Shanghai closed, the price of physical silver was $122. Same metal, same day, 44% difference. Let me make sure you understand what I just said. If you tried to buy silver on a screen in New York, the price was $84. If you tried to buy actual physical silver in Shanghai, the price was $122. If you went to Tokyo, physical silver was selling for $150, a 44% gap between paper and physical on the same day for the same metal. Which price is real? The paper price that can be manipulated with contracts backed by nothing, or the physical price where actual metal changes hands? Here's what they don't want you thinking about. In the weeks before the crash, physical silver was selling for $120 to $150 at dealers around the world, and it was sold out. Dealers had no inventory. Demand was overwhelming supply. Now ask yourself a simple question. If you're a dealer and customers are lining up to pay $150 for physical silver, and your inventory is sold out because demand is so high, why would you lower your price just because a screen in New York shows 84? You wouldn't. The screen shows one number, reality shows another, and the gap between them is 44% and growing. But here's what really convinced me this was scripted. Remember when the crash happened? Friday, January 30th, the last trading day of January, month end. Now let me take you back exactly 1 month, December 31st, the last trading day of December, month end. What happened that day? Silver dropped 15% in one day. Same pattern, same timing, month end. And then what happened? Silver continued its rally in January, went to all-time highs. Now January 30th. Last trading day of January, month end. Silver drops 40%. 2 consecutive month ends. 2 massive drops. Same pattern. Coincidence? Let me show you what else happened on those exact days. On December 31st, the Federal Reserve's standing repo facility handed out a record amount of dollars to banks. Record. The highest ever. And what was happening in Washington on January 30th while silver was crashing? The government was on the edge of shutdown. Congress scrambling. Chaos everywhere. Here's the connection nobody's talking about. The banks that received those record repo dollars on December 31st? They're the same banks that hold massive short positions in silver. The data is public. You can verify this yourself. Month end is when banks need to clean up their balance sheets. Month end is when they need to close positions. Month end is when they need liquidity. And month end twice in a row is exactly when silver mysteriously crashes. December 31st, repo record, silver crashes 15%, then recovers. January 30th, government chaos, silver crashes 40%. Same pattern, same timing, same players. This isn't coincidence. This is a calendar, a script that runs on schedule. Now let me show you what the CME was doing behind the scenes while all this was happening. December 12th, 6 weeks before the crash. Silver is rallying hard, regular people making money, and quietly, without any announcement, the CME raises margin requirements by 10%. Nobody notices. That was the point. December 29th. Silver keeps climbing. CME raises margins again. 25% jump overnight. No warning. December 30th. Less than 24 hours later. They raise margins again. 2 hikes in 2 days. January 28th. 3 days before the crash. CME changes the entire margin system. Fixed amounts become percentages. 9% becomes 11%. 4 margin hikes, 6 weeks. 80% increase in cash required to hold a position. Let me tell you what that means for a normal trader. You bought silver at $60. You've been riding this rally for months. Your account is up big. Life is good. And then without warning, your broker sends you a message. Your margin requirements have increased. You need 80% more cash in your account today, right now. Or you get liquidated. Where does that cash come from? Most people don't have 80% extra just sitting around, so they get liquidated, forced to sell whether they want to or not. And when thousands of leveraged traders are forced to sell at the exact same time, the price doesn't decline, the price collapses. But here's what should really disturb you. After Friday, after the crash, after 10 trillion vanished, the CME raised margins again. Saturday, the day after the massacre, another hike. Gold margins going from 6% to 8%. They raised margins before the crash to cause forced selling. Then they raised margins after the crash to prevent recovery. If this was risk management, they would lower margins after volatility subsides. Let the market heal. Let traders recover. Instead, they increased pressure. They kept their boot on the neck. That's not protection. That's suppression. Now let me show you why this matters beyond Friday. This isn't the first time they've run this script. 1980. Silver runs from $6 to $50, 800% gain. Regular people making fortunes. The Hunt brothers trying to corner the market. What happened? CME created Silver Rule 7, banned leveraged buying overnight. The Federal Reserve raised rates from 11% to 20% in a single move. Result, silver crashed from 50 to 10, 80% destruction. 2011, silver runs from $8 to $50, 600% gain, retail traders everywhere. Banks with massive short positions getting crushed. What happened? CME raised margin requirements 5 times in 9 days, 84% increase. Result? Silver crashed from 50 to 26, 50% destruction. It took 13 years to recover. Now 2026. Silver runs from 26 to 121, nearly 400% gain, the biggest rally in modern history. What happened? CME raises margins 4 times in 6 weeks. China raises margins and steps back. Fed chairman announcement time to cause maximum reversal. Government on edge of shutdown. Shorts get their exit through paper manipulation while physical sites untouched. Result? Silver crashes 40% in a single day. The fastest destruction of the 3. 1980, 2011, 2026. Same pattern, same tools, same timing, same destruction. 3 times in 50 years. Every time silver threatens to break free. Every time regular people start making real wealth in precious metals. Every time gold and silver start exposing the weakness of paper money. The same script executes. Once is an accident, twice is coincidence, 3 times is policy. But here's what should make you furious. While paper prices were crashing, while retail traders were getting liquidated, while 10 trillion was being erased from screens around the world. Guess what central banks were doing? Buying, not selling, buying. 800 tons of gold accumulated by central banks last year, the fastest pace in decades. The dollar's share of global reserves has dropped to 58%, lowest since 1995. For the first time in modern history, gold now represents a larger share of central bank reserves than U.S. Treasury bonds. Let that sink in. Central banks around the world now trust a metal more than they trust America's promise to pay. They crash the paper price. Then they buy physical at the discount they just created. Retail sells in panic. Central banks accumulate in silence. It's the greatest wealth transfer in modern history. And it happens every time they run this script. I know you're scared right now. I know you watched your portfolio bleed. I know you're wondering if you should sell what's left and walk away. Let me tell you something. When silver was at 121 and everyone was euphoric, logic said be cautious. Now when the market is drowning in fear and panic, logic says the opposite. When everyone is fearful, opportunity emerges. That's not financial advice. That's just how markets have worked for centuries. Fear and greed, cycles that repeat. The people who panic sell at the bottom regret it. The people who buy when there's blood in the streets remember it as their best decision. Which one will you be? Here's the question I can't stop asking myself. If gold and silver truly don't matter, if they're just relics of a past economy, if they have no place in the modern financial system, then why do they keep doing this? Why coordinate a Fed chairman announcement with a crash? Why have China step back at the exact moment liquidity was needed? Why raise margins 4 times before and once after? Why does the paper price show 84 while physical sells for 150? Why run the same script on the last trading day of December and the last trading day of January? Why does the standing repo hand out record dollars to the same banks that are short silver? Why spend so much effort suppressing something that supposedly doesn't matter? They say it's market forces. They say it's supply and demand. They say it's normal volatility. But 10 trillion doesn't vanish in 6 hours by accident. 531 tons of paper don't trade while 0 physical moves by coincidence. 44% gaps between paper and physical don't appear in healthy markets. You don't fight this hard against something that doesn't matter. The intensity of the attack tells you the value of the target. They're not protecting the market. They're protecting the dollar, protecting the system, protecting the narrative that paper money works. And the fact that they keep running this script, the fact that they've done it 3 times in 50 years, the fact that they will do it again, tells you exactly what precious metals represent. A threat, a way out, real money that exists outside their control. That's why they attack it. That's why they crush it. That's why they will never stop trying to suppress it. Because if gold hits 10,000 and silver hits 300, what does that say about the dollar? What does that say about 50 years of money printing? What does that say about the entire system they've built? It says the paper has failed. It says the game is ending. It says everything they told you was a lie. That message cannot be allowed to spread. So they write scripts like this one: Tuesday, Thursday, Friday, 72 hours of controlled demolition. And they expect you to panic. They expect you to sell. They expect you to give up and walk away. But now you know the script. You've seen the 72-hour timeline. You've seen Trump's contradicting signals. You've seen China's perfectly timed exit. You've seen the 531 tons of paper with 0 physical movement. You've seen the 44% gap between screen price and real price. You've seen the month-end pattern. You've seen the standing repo connection. You've seen the margin hikes before and after. You've seen the same playbook executed across 50 years. It was scripted, every single piece. They called it a crash. I call it the 3rd time in 50 years they told you exactly what they fear. They called it volatility. I call it a 72-hour execution. They called it risk management. I call it the system showing you its hand. And what they fear is simple. You holding real metal outside their system, beyond their control. Remember that 44% gap? Paper at 84, physical at 150. That gap isn't a glitch. That's the system telling you which price is real. Paper is just a promise. A number on a screen. Metal is real. It sits in vaults. It can't be printed. It can't be hacked. It can't be margin called out of your safe. They can crash the paper price. They cannot crash the metal itself. They can liquidate your futures contracts. They cannot liquidate the silver bar sitting in your possession. 3 times in 50 years they've run this script. 3 times silver eventually recovered and went higher than before. The question isn't whether silver recovers. History says it will. The question is whether you'll still be holding when it does. I started this video with 72 hours, Tuesday, Thursday, Friday. Now you've seen it all. The setup, the peak, the execution. It was scripted, written in advance, rehearsed over 6 weeks of margin hikes, timed with government chaos, executed with paper contracts while physical sat untouched, coordinated across continents with precision that would make military planners jealous. They called it a market event. I call it financial warfare, and I call it the clearest signal in 50 years of what they truly fear. Real money in real hands beyond their reach. Now you know the script. What you do with this information is entirely up to you. But remember this moment. Remember how you felt when you watched your portfolio bleed. Remember the fear. Remember the confusion. Remember how they gave you no explanation while 10 trillion vanished. And remember that you now know something most people will never understand. It was scripted. Subscribe to this channel right now because this is the kind of analysis that separates those who see what's coming from those who are blindsided by it. While everyone else is watching the headlines, you'll be reading the ledger. And in finance, the ledger always tells the truth before the news does. This is your advantage. Don't waste it.